Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Todd Harrison, who has managed money. He's an investor and author, and he's founder and CEO of Minyanville, an investing website that many of you have gone to and found your information to for over a decade now. So thank you for joining us here today, Todd.
My pleasure. Thank you.
Great. Now, Todd, it's kind of a bloodbath out there unless you're a trader and you're on the short side. I mean, the retail investor money doesn't exactly go short, but for the smart money, the people who can go long or short, it's a good day to make money. What is your opinion on the correction we're having now? Is this just a normal, healthy correction where there's tax loss selling before the end of the year, or do you think this is something much worse that's coming?
Well, I don't think there's anything normal about this market, and there hasn't been for a few years. This is not your father's financial markets anymore. There's a lot more. There's a lot more at stake, and a lot more influences that weren't present, whether it's government intervention, whether it's high-frequency trading, whether it's just the DNA of the market is completely different. But to your point on the actual market, I mean, as I sit here on November 15th at 2:03 in the afternoon, the S&P's at 1350, the Nasdaq's at 2530 or so, and the BKX is at 47. This is where the market needs to hold. I think a lot of people were looking at the 200-day in the S&P, which is up around 1380 or so, and said, if it breaks there, it's all over. I think that the BKX, the banks, are the stronger tell here, the 200-day, and I think there's a trend line in the S&P that we're sitting on right here. That dates back to the summer of 2011. Technical analysis is a better context than catalyst, but it is a good way to frame risk. If the market is going to hold, and I think it's going to give it an upside try here, maybe start to spark some performance anxiety into year end. But it's a pretty dicey environment two ways here because there's so many extraneous influences.
Yeah, and there's always the possibility of the Fed, without any warning really, just stepping in here if it doesn't like what the market behavior is doing, because I know the Fed is already planning on expanding its balance sheet starting again in January, but there's always the possibility, I guess, the Fed could step in before then and intervene further in the market.
Yeah, I mean, it's, at some point over the course of the last decade, the mandate of the Federal Reserve has completely shifted, and they went from, playing defense to a more offensive position. I use that double entendre on purpose. This is not a free market. This is a system formerly known as capitalism, which has a slew of unintended consequences, as we're seeing, whether it's the societal chasm, whether it's the unintended consequences such as social mood and things of that nature, which ultimately do shape the financial markets. One of the great misperceptions, I think, in financial history was that the crash caused the Great Depression, when in reality the Great Depression caused the crash. It's a subtle but important observation as we kind of move forward, into the final trading days of 2012 and look ahead to 2013.
Yeah, and I think that's a great point about the crash of 29 that you talked about, is that all that free money, that cheap credit that came in there before then, there was a lot of misallocations of capital. You had Hoover, who started with the Smoot-Hawley tariffs, and he started making it very difficult for business people to do free trade and start trading outside the country, and all the tariffs were put up, and it made things disaster. And in the market, crashing was just a consequence. It was an effect of all the other stuff that you said, and I think that's basically what's happening now. Any other further market intervention aside, I mean, rationally, the stock market in general, in my opinion, it was overvalued, but for the Fed printing devalued currency and giving, Wall Street more money to speculate with, because you look at the PE ratios and you just don't see that much real revenue growth from the majority of the companies here. You see margin compression, and that's not a reason when you see all of these fundamental factors to want to own stocks in general, is it?
Well, that's part of it. I think also if you look at the the sequence of events over the course of the last decade and the bubbles and busts that have come through, and the shelf life between those events has gotten shorter and shorter, and I think that's a function of technology, which has really increased the rate on everything from mating rituals to business cycles. When I was a kid, you used to have to get somebody's phone number and call them and wait a couple days and take them out, and now you can go on Facebook and get the whole banana. And I think that plays out across a few different spectrums. And we've seen a lot of investors getting burned at the top and savers getting burned at the bottom, and there's a lot of financial fatigue out there. And not surprisingly, we've been talking about this in Minyanville for quite some time, and on the margin, I would offer that this is constructive. In order to get through it, we had to go through it. So for a long time, I think we were living in a state of denial, and now that the reality check has been in play, and not so much in the market. There's a difference now between the market and the economy, a big difference between the stock market and the economy. But it's become a very tenuous and fragile equation, given the interwoven nature of the global financial construct, and very derivative-laced global economies where all these banks in Greece are now connected to France, or now connected to Germany, or connected to the U.S. And that's why what happens overseas does matter for us, and why it's going to continue to matter going forward.
Yeah, and the supply chain is completely global. It's completely the just-in-time supply chain now, whereas in the past everything was more vertically integrated, and a company like GM or Ford or a local American company would have all of their supply chain kept here in the United States. They wouldn't mind paying a little bit more money, but everything, because of the global supply chain, is so is so dispersed now all over the world that you have goods going from China to one country to be assembled and then back to China and then shipped off to the United States or there as a finished good. So on top of all this, we have the macroeconomic situation, which you have this inflation versus deflation debate going, and there's a lot of smart people on both sides. So what is your opinion on this in terms of like your market experience and all the research you've done? Do you have a more distinct opinion on the inflation versus deflation debate?
Yeah, I do. I think there's inflation in things that we need, such as education, healthcare, and energy, and we have deflation in things that we want, whether it's plasma TVs or cell phones or things of that nature. So it's I think we're it's a bifurcated, as are most things these days. It's a bifurcated discussion. There's no one overriding theme in terms of inflation, deflation. There's a confluence of dynamics that are interplaying at the same time. So it's one of those. There's no easy answer per se, but that's how I see it playing out.
It's very interesting. Yeah, and I think, you have, like you said, the free market forces in the consumer discretionary stuff because you have competition in Apple. You have Samsung and Google and these guys coming out with higher quality products at cheaper prices with the smartphones and the other stuff, and they're hurting Apple's margins, and that's very good for consumers because of the competition. So you, consumer at the margin, can go and get one of those smartphones that maybe it's not an iPhone, but maybe it's selling for less than half the price, and you can go get a really good Samsung smartphone. So that would be deflationary, I guess, in that sense. That's free market forces. But then, like you said, you have the inflation on the other hand, which is really hurting, in my opinion, the stuff you have to have, the food, the energy, the healthcare, the oil, the stuff like that at the pump.
I agree.
Okay, well, moving on here, what is your opinion on entrepreneurship these days? Do you think it's going to be easy at all for any entrepreneurs to start a business under the Obama administration, or do you think it's going to be a lot more difficult going forward? Because it just seems like they're saying that jobs are going to be created, but I have an entrepreneur network I talk to, and it just seems like it's going to get more difficult for entrepreneurs and small businesses to be able to create jobs here in the United States.
Yeah, well, I think that to a degree, it's the cream will rise to the top. I'm a big buyer of the millennials, in terms of their abilities and capacities going forward. I have 3 kids at home. 2 of them are twins who are about to turn 9, and they have just an incredible skill set that I never had when I was their age. And I think that as there's a big difference between experience and and skills. For better or for worse, a lot of these up and comers don't have the baggage, don't have the memories. Many of them haven't experienced the housing crash or the technology crash, or and they don't really care about it. They're not scarred by it. And I think that this next generation, and it's going to take some time, but I think that they are going to to demonstrate the fortitude and the stick-to-itiveness necessary to really do some amazing things in some amazing ways. So I'm very bullish looking out. Just as I was bearish in 2006, 2007, and I was early. I will be early again. I'm not saying it's right here, right now. When I talked about the market before, that's for a trade. I mean, I wear a lot of hats, and that trading hat, as I'm actually sitting here talking to you, I just bought some S&P calls for a trade. Whether that's right or wrong, it remains to be seen. But it's just that it's a trade, and at the end of the day, trades are made to be taken. For me, I have 2 buckets. I have a trading bucket and I have a long-term bucket, and that long-term bucket's been dry in cash for a long time, and I've missed a lot of the moves down, and I've missed obviously a big move up, but that's okay, because you can't trade with money that you can't afford to lose. You have to play within your your own personal parameters, and that is distinct for everybody. The time horizon and risk profile is very different for every individual, which is why one of the reasons that Minyanville does not give advice. We talk about what we're doing and how we're doing it and why we're doing it, is because it's borderline disingenuous to go out there and jump up and down and say to buy a stock when you don't know who's buying it or for why.
Exactly, and we've written research reports and we've laid out model portfolios and stuff like that, and there's always the 1 or 2 customers that doesn't understand everything that goes into the stuff, that doesn't understand, with my capital, I like this one company more, even though the model portfolio says you need to buy a basket or an ETF of these stocks, and they go and they bet it on red. Unfortunately, that's human nature more than anything else.
Yeah, I mean, and that's one of the big, there's a couple of, real, issues in terms of people's understanding. Where they look at, buying a SPY or an ETF and saying that they're diversified, but that's not that's not diversification. That's just, it's correlated with the market. That is the market. And I think people need to do their homework. And I think, if something good comes from all things bad, I think that, the need to empower yourself and to be more financially aware of what happens and why, which has really been the mission statement for Minyanville for the last decade. I think that's, a lot of people are doing that as a function of need now rather than want. And for whatever the reason, I think that's going to, that will ultimately benefit the collective.
Now you mentioned you haven't started investing in any long-term fundamental trends yet, but is there anything out there that you're watching that you think people should start doing some research on, any types of long-term fundamental trends that you might be interested in, like growing world population, how people are going to want more cleaner water or food or something along those lines?
Well, yes. When I say, keep in mind, when I say my long-term bucket, that's just that, that's money that I can't afford to lose, and I don't want to lose, and I won't risk that. But thematically, and we've been talking about this on Minyanville for about a month now, before it really, actually before the 60 Minutes piece. I think the single best investment theme for the next decade is cannabis stocks. I can tell you 4 reasons why I think marijuana plays, if you can find pure marijuana plays, not, Archer Daniels and Altria probably dominate the industry, but if and when, of course, but there's a lot of other elements to those stock prices. But the 4 reasons why I like that complex is A, it provides much needed tax revenue. B, it creates jobs. C, lowers the crime rate. And just from a trading, from a logistical standpoint, nobody on Wall Street currently covers the sector, which leaves a lot of room for brokers to initiate coverage, and that's going to increase awareness. I don't know when this happens. I think it's gonna take some time, but since we've been talking about on Minyanville, obviously the 60 Minutes piece ran, and now all of a sudden I'm seeing articles, in more mainstream financial, media outlets that are talking about this very same dynamic that we talked about on Minyanville last month.
That's a very interesting point, and I just read I listened to another interview where you were speaking with Barry Ritholtz and talked about that, and then I also read another piece about investing in the marijuana sector, and like you said, there's no analyst covering it, so there's always then, when there's not a lot of analysts covering a stock, it means there's a lot of value in the stock. If you do your own research and you know what you're doing, you have a chance to really hit a potential 5 or 10 bagger. I've had success with that. Because, there's not 80 analysts covering a stock like Apple or something like that, where it's very difficult to find hidden value.
Yeah, and I've never been a bandwagon type of guy. I for better or for worse, sometimes that's been to my detriment. The easiest money in trading is as I like to say, the easy money is between the 20s, meaning like if you're in the red zone, to use a football analogy, or if you're playing for a trend to turn, you're probably going to be early, and you have the capacity to more likely to not get stopped out. But that's always been my stylistic approach. I like to sell rallies and buy dips, and I'm not a momentum monkey like
contrarian.
I always have been. I'm not quite sure why. I must make it very difficult for my wife at times, but I do think that this is because it's so under the radar, and because I think that for the reasons discussed, particularly the tax revenue, the jobs, and the crime rate. I think that we will get to a place where there will be a marijuana industry, and a very big one, and there's going to be a lot of money made. I think we'll look back in 10 years from now and say, wow, this is pretty amazing that more people didn't see this early, and from just kind of a broader socioeconomic lens, when the last Great Depression ended, they repealed prohibition. And I think when this Great Depression ends, we'll see the legalization of marijuana. So I think there are some parallels there, and I'm looking for ways to play it. But there are very few ways to play it. But there are some. I can't talk about them because they're too thin, and I'm not going to do that because it's not my style.
I completely understand. And you mentioned the socioeconomic trend, and we saw that in the elections with Colorado and Washington, how they both voted to legalize marijuana to a certain extent, and marijuana is already legal for cancer patients in, I think, almost half the United States, right? So the fundamentals are shifting for that.
Yeah, I agree. Well, fundamentals fundamentals have always been there. To correct that, I think that the psychology surrounding the fundamentals is changing, and that might be a function of need. Again, we need tax revenue, we need lower crime rates, we need more jobs. We have overcrowded prisons, of which much of the population is in there for marijuana-related charges. So it's not a panacea. And I'm not talking my position per se, whether it's on the issue or with regard to the stocks that I own. It's just something I think that's inevitable, and I think it's going to happen, and I think it's going to be a very, very big opportunity for those who get in front of it.
Yeah, I think that's definitely something our listeners should start doing some research on, definitely do extensive research on before they even consider putting any capital to work in that area, since you said it's so new and there's really tiny companies. As we wrap up the interview here, can you please tell our listeners more about your book, since you published it last year, and then more about Minyanville and your other charity work?
Sure. The book is The Other Side of Wall Street. It talks to the difference between net worth and self-worth, and the difference between having fun and being happy, and not looking for validation at the bottom of your bank account. Things that I did when I was running a $400 million fund, and it doesn't make me a bad guy, or I wasn't a bad guy. I just don't think I was, but my sensibilities were skewed, and 9/11 changed that for me and shifted my direction, and I wanted to do something meaningful, and that was building a community like Minyanville, which I think is has a lot of really tremendous people offering really tremendous insight, and obviously there's other elements there. We have a studio division that won an Emmy Award, which I'm proud of our team for that, and we license our content, and we have a gaming engine for children, and so it's a vertical theme brand, although some parts of it are more evolved than others. And simultaneously, back when I started this after 9/11, I also started the Ruby Peck Foundation for Children's Education in honor of my grandfather. He had passed away, not in 9/11, but right before. And we raise money for various educational endeavors. We have our our annual Festivus party on December 7th in New York City, which is an awesome time. We rent out Hill Country Barbecue, and we have 3 tribute bands that are just insane. And we get about 500 people, like smart, good, good folks who are good at what they do and better at who they are, and they all converge for one night, and we celebrate our journey and shake some hands and share some hugs, and look forward to the year ahead. And in the process, we help a lot of kids, and this year we're going to be helping the children who were impacted by Hurricane Sandy, which just completely devastated the tri-state area.
Very good. And the Festivus reference there from Seinfeld is just classic. It's one of my favorite Seinfeld episodes ever.
Yeah, there will be no airing of grievances.
Well, in wrapping up this podcast, Todd, I just want to thank you very much for your time and your market views and all your other insights, and hopefully we can have you back on again soon.
I appreciate it, sir, and good luck with everything that you're doing and trying to educate and inform and empower. I think in that regard, you and I are pointed in the same direction.